Hello and welcome to Big Deal. I'm Nisha Poddar. Now, REITs and InvITs have over the last few years evolved in the country as an important asset class. Now, budget proposal, however, throws some uncertainty in this particular space regarding the returns for the investors, which is so critical. Now, budget proposal is to bring under its tax net the income distributed by REITs and InvITs in the form of debt repayment. Let's discuss this issue threadbare with the experts from the industry. Let me welcome on the show tax expert Ajay Roti, who's a partner at Dhruva Advisors. And from the audit side, we have Adarsh Ranka, the partner at EY. Vikas Kodalya is the CEO at Embassy REIT. And Gopal Agrawal is sitting right here in the studio with me, an investment banker at Edelweiss who has worked on many of these being listed on the exchanges. Gentlemen, so good to have you on the show. Now, let's first get an industry view, because how does this particular tax proposal impact you as a company? And there have been representations made to the ministry to rethink on this or to give some dispensation on this budget proposal. So what's the update coming in on that? Is the government receptive to the idea of a rethink?
Yeah, thank you, Nisha. So firstly, the current proposal to tax the debt repayment component impacts the distribution yield by around 50 to 100 basis points, which roughly, if you look at it, REITs being a total return product, envisaging anywhere between mid to high teen return as a target return, it does impact the total return, but but it's only the distribution component which gets impacted. In terms of what we're doing as industry, we are making suitable representations to authorities, given that this is an attractive product and it has been successful till date, especially with retail investors. While I wouldn't want to comment on the specifics of the representations being made, but the conversations are broadly around reconsideration of the proposed tax provisions or mitigation measures around this proposal. But I just want to say that this is a new product. Some teething issues are to be expected, but in general, government and regulators have been very supportive since the launch of the REITs.
That we know, Vikas. In fact, over the years, many changes have been made to make it so attractive for the Indian investors, and now it has really reached that maturity. And also during an interest rate hardening cycle, we expect this part equity, part fixed income kind of asset class to grow in prominence. So at this time, it's definitely coming in as a dampener. Ajay Roti, from the tax perspective, help us understand what is the confusion and the issue all about, and how much of it can be really sorted out at the company's level if this tax proposal was to be implemented as is from 1st of April?
Yeah. So, Nisha, the issue is really on, different nature of income that will come from holding REIT units and how those are taxed. And like you said, the government has been proactive, has introduced a special regime for taxation of returns from REIT and the InvIT units. To very simply put, and I won't get into too much technicalities here, it enjoys a pass-through status. These trusts enjoy a pass-through status. Therefore, all streams of income are either taxed in the hands of the investment trust or the unit holder. There are specific treatments for dividends, for interest, and for rental income that the trust earns. Now, there was a fourth category of income that would get distributed, which is really this proceeds from repayment of loan. And that was not being taxed in the hands of the unit holder nor in the hands of the trust, because it was by nature and on first principles a capital amount that was received on repayment of loan. What the budget proposal does is to tax this in the hands of the unit holders. And the problem is not just that. The problem is really about the nature of taxation, which is the budget proposal proposes to tax this as income from other sources, which really means it is at the normal rates. So for all the individuals, it could go as high as 39%. And for foreign investors and other investors, it becomes a other source income, not a capital gains. So even if this were to be taxed, and if this was to be brought into taxation, one consideration could have been, can this be in the nature of capital gains? Because essentially it's a return of capital, and therefore can you tax it at that? The issue is really that, which is, one is you're taxing it and you're taxing it under the income from other sources head.
Yes. So that is really the crux of the problem. And we have spoken to actually a lot of these listed REITs as well as InvITs. And, Adarsh, throw more light on this aspect. See, different companies have been impacted in a different manner. Some of the companies have told us, like IndiGrid, that they are less impacted. Now, Embassy in the past have told us that maybe the returns and the yields to the investors would vary and get impacted by 50 to 100 basis points, and 40% of the cash distribution comes under this. And that particular figure really varies. So why this differentiation, and can this be changed overnight?
Right. So, Nisha, if we compare across the REITs and the InvITs, right, the loan repayment component varies from a 4% to a 48%. So there's a lot of variance depending on the structure. Now, that's, I would say, one of the key reasons why many of the trusts have a different view in terms of the level of impact in their particular case. If I also look at a comparison between a REIT and an InvIT, generally the InvITs are more leveraged. So even between a REIT and an InvIT, the InvIT is expected to have a larger impact because the loan repayment component would be higher in terms of the distribution component. Now, in terms of, if I look at the second part of your question, right, I think with the proposed amendment, the way I think Ajay mentioned, if you look from a unit holder's perspective, since dividend income is going to be exempt, right, I think the intent of the trust and the objective of the trust would be to distribute more dividend rather than the loan repayment, yes, if the way the amendment currently stands.
Yes.
Hence, in terms of, I think the impact, clearly, what would be critical in terms of the impact would be the capital structure, the reserve position, and the cash flow. And let me take a quick example. Yes. So if there's a company which has a lot of cash flows which is generating, yes, it would need to have positive reserves to distribute dividend, yes, and vice versa. So I think having a balanced approach in terms of a capital structure and alignment between the reserve and the cash flow position, I think would really be important from a company, from a trust perspective.
Right. So that's why the differentiation and the difference in impact on different companies. But Gopal, while making this particular asset class attractive, the investors had to keenly look at their yields, the returns. The redemption of units is one thing, but the fixed income is something which is the most attractive part. And right now, with interest rates going up, it will continue to be the attractive bit for the REITs and InvIT space as an asset class. So, as an investment banker, do you think that this particular tax proposal, if implemented, is going to reduce the attractiveness, and what's going to be the impact on the investors, according to you?
So, as rightly pointed out by you, Nisha, this is a fixed income product. Typically, the driver for this is basically what is my post-tax yield, yes, which I am getting from this, yes, investments.
Yes.
And as you know, some of us kind of commented on this, this could have an impact of anything between, let's say, 50 to 100 bips,
yes,
on my yield.
Yes.
And compared to, let's say, a fixed deposit, the delta was roughly around 150 to 200 bips. So the delta gets kind of reduced. So to the extent, of course, would this have a short-term impact? If this was to get implemented, the answer is yes. But I'm sure in the long term, people will figure out, some kind of a structuring solution.
Yes.
Because the point remains that, or let me look at it, from a tax perspective. All they are saying is that any form of distribution should be taxed.
Yes.
While as the nature of distribution is basically nothing but repayment of capital. When you look at debentures, when you look at bonds, when you look at anything else, yes, there is a different treatment when you return the capital. While as here it is treated differently. So my sense is in short term it would have some impact for sure, but in long term I'm sure we'll be able to kind of resolve for this.
Right, but Gopal, the double non-taxation is something that the government tried to plug, and it created so much of uncertainty for the entire sector, which I'm sure the government had also not anticipated, given the varying nature across various companies which are in the listed REIT and InvIT space. But Vikas, how are your investors really reacting to this? Are they raising concerns about this, about their yield proposition? I mean, 1% of their post-tax return coming down is actually a big number.
Yeah, so Nisha, there are two parts to this. One, obviously, there is uncertainty, as all our panelists mentioned. So, we'll need to work with the authorities. They have been supported in the past to see how we can remove the uncertainty on how the whole taxation works. Because even today, the SPV debt amortization or repayment of debt we're speaking about was being treated as towards repayment of capital to some, in some form. So I think that clarity needs to emerge. Obviously, retail investors are seeking explanations or clarifications on how this will work. But more importantly, I think if I want to take a step back, we mentioned about rising interest rates, we mentioned about total return. I just want to say large part of our effort since the last 4 years we got listed has been on retail investor education of how in India, this product is a total return product. Unlike you would say it's a fixed yield product in some of the other countries, simply because the growth element is huge from an India context. And again, I mentioned last time, we are undertaking record development. There's a lot of growth to the NOI since we listed till date. And, both in terms of inorganic acquisitions as well as our organic initiatives, the growth will translate into NOI and distribution. So, from a medium to long-term perspective, this is still a very attractive investment proposition for retail investors. And a lot of the investors do understand that. I think it's just the short term. There has been uncertainty. Again, that's being reflected in the way we're seeing performance, but we believe that this will correct itself over the course of time.
You spoke about retail investors, but Vikas, any word from the sponsors, the big private equity players, the foreign players who are invested in, REITs and InvITs like yours? They had come with a lot of exuberance to India, and they are the ones who have pumped in a huge amount of cash to make REITs and InvITs so successful so far. So any word and concern from that category of investors so far?
Yeah, from a foreign institutional investor perspective, we have a book comprising some of the leading names globally. A lot of them are sophisticated investors. They have been invested in REIT product globally. So they understand the total return aspect of it. So from that perspective, they are more focused on the growth levers and what are we doing to create value from a long-term perspective. However, in the immediate term, we understand that they will also want to seek more clarity, and that will help both in increasing participation from retail investors, which really helps in better price discovery and efficiency in the market. So I think overall, suitable representations, hopefully leading to better clarity on the way to tax this will lead to more participation from retail investors, which also then overall helps all the investors in better discovery, efficient price discovery mechanism. So I think it's all linked. They understand that this impacts in the short term. They're just more focused on, okay, how can we resolve this? And how fast could you just make representations to the government and get more clarity? That's their focus.
Right. So more representation. And Vikas, of course, people in the industry know that you were on the investor side at one point and now the CEO of one of the REITs as well. So, all right, gentlemen, hold your thought a little more to discuss on the confusion and the conundrum, what the budget has really thrown on this particular space as an asset class, REITs and InvITs. We'll discuss more on that when we return after this very short break on Big Deal. Stay tuned. Welcome back. You're watching Big Deal and we are discussing the impact of budget on REITs and InvITs as an asset class. Now, Ajay Roti, we were discussing the tax conundrum after the budget proposal where the representations have been made for dispensation or a rethink by the government. But there's one more point on the debt repayment as part of the income distribution, which has come under the tax net as part of the budget proposal. There's one issue that has been raised by some of the people who have reached out to us to understand this, that only a part of it is going to be taxed. Only the piece over cost of acquisition is the one portion of debt repayment which stands to be taxed. But then there is also a SEBI regulation which also does not permit part redemption of REIT and InvIT trust. What is this confusion about, and what is your thought process on the solution for it?
Right. So, Nisha, the problem is really because the main provision which is being brought in to tax this receipt, which is the debt repayment portion, says that this will be taxed as other sources. But there's a carve out which says that, however, if this portion is being paid as a part of the redemption, then you will get a deduction for the cost of acquisition, which is if somebody were to buy a unit at say 300 rupees and then you got some portion of the debt repayment as a part of the redemption when the units are redeemed, then you can deduct this cost that is there. But that is at this point academic, because like you rightly pointed out, the SEBI regulations don't permit a part redemption. According to me, the way that they have said that this has to amount in a reduction of the cost of acquisition is how they should have addressed the entire amount of loan repayment. Because essentially, on first principles, this is a capital that is coming back. Therefore, you reduce your cost of acquisition, which is to say, just taking the same example, if somebody bought the unit at 300 rupees and then you over a period of time got various amounts as loan repayment, you keep reducing your cost. And then when you eventually sell it, you get a lower cost base. What this does is all these receipts get taxed as capital gains. They don't go untaxed, but they get taxed as capital gains, which is the right way to tax it. Therefore, the way they've done a carve out for redemption is how the entire provision in my view should have come, and that would have solved a lot of problems.
Right. And others, taking all these confusions and various technicalities into account, is there a solution that you're already proposing to your clients on this? Can there be a change in the structure as well as the way the distribution is done?
So, Nisha, while impact cannot be completely negated, but there are clearly some mitigating steps that can be taken. So, if I look at broadly two areas, first, trusts which are looking at listing, naturally, they have a flexibility to revisit their capital structure, and that many of them are evaluating. If I look at the current listed trust, maybe there are 2-3 things they could look at. The first is, because this amendment would be applicable from 1st April 23, right? They could look at maximizing their distribution under the loan repayment option before 31st March 23. That's something which will help. While in principle possible, how practically it will happen, I think we'll have to see.
Right.
The second thing many of them are looking at is tax arbitrage.
Yes.
Like Ajay said, if loan repayment distribution would be taxable as income from other sources, which is at a higher rate, if through restructuring some of the SPVs, the trust could generate long-term capital gain, then from a unit holder, the tax arbitrage is possible.
Right.
And then again, some other things like distributing dividend, but if you have negative reserve, can you look at some of your accounting policies? So there are 2-3 things which I think many trusts are looking at to mitigate the impact.
All right. And Gopal, how does it impact the future pipeline going forward, as well as the attractiveness? And have you already seen some of your future prospects really raising concerns about it? We know at least one big private equity firm is planning for a REIT listing.
So I think as far as the attractiveness of this, let's say, asset class is concerned, Nisha, as I said, there is FD which is giving you 4-5% return, and post-tax is like, hardly anything. I mean, leave apart some of the recent interest hikes, it doesn't even cover for inflation. REIT and InvIT definitely provided investors, whether it is the retailers, the HNIs, or I would say even the foreigners, with an asset class which could give them, let's say, X amount of anything between, let's say, 8 to 9% or even 10% yield over a long period of time. So from that perspective, the attractiveness of the asset class is for sure there. As I said, in short term, people will evaluate, in terms of how this whole tax thing
They'll bake in this particular
but
tax
to me, honestly, there is enough and more, I would say, kind of a gap, in terms of having this as a product, while as there's enough and more investors who are looking at, investment opportunities. So to me, I think this could be a bit of a short-term phenomena, which will kind of overcome, let's say, sooner than later. But I don't think so. This should really impact their mood.
The pipeline also?
No, I don't think so. It could get delayed a bit, because as I said, we'll have to work with some of our clients on the structuring part of it. But I don't think so. It should, it would kind of dampen the mood.
All right. Ever optimist investment banker, I must say. But final question to you, Vikas. Does it change the prospects and the way you raise funds in the future and the structuring of that very quickly? And what are you expecting for the government to do in this regard?
Nisha, I mean, we are here for the long term, to create value long term. So, I think from a business perspective, the way we would look at financing, whether it's debt or equity, nothing changes. We continue to execute on the business strategy. We want to create long term value, and we're continuing the construction, the leasing mark to market, and also looking at potential acquisitions. So nothing changes really from a medium long term perspective. We're doing the business with the same strategy, the same core 4 pillars we had laid down. And just from a government perspective, from the government and the regulator perspective, we'll continue to work with them, continue to make suitable representations, and we are hopeful, that they will consider the requests and representations being made by the industry.
All right, a lot of work is going on making these representations, and let's see what dispensation can come in, or is it going to be the order of the day? But I must say, REITs and InvITs have become a prominent asset class, and only to become more useful for the investors given its fixed income nature, along with the unit upside that also can be taken care of. So equity as well as fixed income combination makes it very suitable for investment, and that's what the government had looked at when they first started. And in fact, a market regulator is also very keen for this particular product to really come up in a big way. And on the other hand, for capital intensive sectors, it's a great way of offloading assets and raising money for the future assets to be also executed. With that, it's a wrap on this edition of Big Deal. Thank you so much, gentlemen, for coming in and sharing all your views on this very technical subject. Thanks so much.